Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. After a fairly lean period, it feels like the M&A market is bouncing back nicely with a number of deals announced over the last year or so. Headline deals include a consortium from the Middle East bidding for Santos, James Hardies' purchase of Azek in the US. There's also a US group potentially buying online real estate portal Domain and a bunch of other deals, or at least rumoured deals, in the smaller end of the mining sector. For an update on what's happening, I welcome into the studio this morning Sandy Mack, Head of Corporate at Corrs Chambers Westgarth. Sandy, welcome back to Fear and Greed.
Thank you very much for having me, Sean.
It just seems a lot busier now than it was 12 months ago.
You know what? It does. But at the same time, and I think this term maybe is used a little bit frequently, but I feel it's apt at the moment, which is this cautious optimism in the market on M&A. And we're involved in a number of the transactions that you've mentioned recently. And so it's interesting that some of these deals, they were on foot before Liberation Day and have continued to progress. Others have come around after Liberation Day. But I think it's fair to say that at the beginning of the year, we all started with a great deal of optimism about what was going to happen in the M&A market. And I had predicted at the end of last year when we spoke together that there was going to be a real resurgence in M&A. It feels like that there was a little bit of a hiccup at the beginning of the calendar year. But I think market participants are getting back into the swing of it again. And I think that there is now a renewed enthusiasm to do deals, but they have to be the right deals.
Okay, so let's just park Liberation Day for a moment. We'll come to the US. Is it about otherwise? Is it about lower interest rates? Is it about the economic outlook? Is it about boards just seemingly getting a little bit more confidence about balance sheets 3 or 4 years after COVID? Why is it 2025 been such a good year?
I think it's a function of all of the things that you mentioned, Sean. Interest rates, lower interest rates in particular, do make a difference. And I think that the desire to grow and certainly private equity and this ubiquitous dry powder that we talk about all the time and the need to do deals. We've had a real period of pent-up demand coming up into this year. And the expectation from all of the market participants and the advisors was that we would see this year be a real bumper year. And I think we've seen some really great deals get announced. And some of these were in the making, like the Domain deal in which we were acting. They were in the making before the beginning of the year. But others, like the Santos transaction, only came into the market after January. So there is a real desire to see growth and to do the right deals for the right value. I think Australia is a huge beneficiary of a lot of flow of capital coming in from cross-border transactions, which is another thing that we predicted at the end of last year. And I think we are starting to see a lot of that come through.
Okay, so that kind of introduces the idea of what's happening geopolitically, and nothing is bigger. Not just tariffs, but trade policy, economic policy in the US, one big beautiful bill. How does that play out on M&A in this country?
There is nothing M&A participants hate more than uncertainty. And I think all of those things led to a period of uncertainty. And then you combine that with not just political and economic policy, but you have geopolitical instability as well in all of the recent events that we've seen in the Middle East. And I think that if you go and speak to anyone who is a practitioner in M&A in the United States, they will tell you that Q1 calendar year 25 was not a great time.
Right.
They really had a massive dip in M&A activity. Not only was it not what they were hoping it was going to be, because they all came into 2025 thinking it was going to be a real bumper year with a political regime that would facilitate from a regulatory and economic policy perspective lots of transactions. And that took a real hit sometime in Jan-Feb. But I think everybody is starting to feel much more optimistic now. It's starting to settle down. People are starting to factor in some of the uncertainty that comes about and have decided to just go ahead and do deals. Lower interest rates definitely help that dynamic as well.
Just transferring that to Australia. So we're talking about the US there being a bit disappointing. In Australia, obviously, it hasn't been. Does it, at the margin, make Australia a better place to invest if you're an offshore fund manager looking to put their money somewhere?
Oh, look, I'm highly biased, obviously, but I do absolutely think so. And I think that's anecdotally and statistically being proven as well. What we are seeing, and if you just look at sheer stats in public M&A transactions, there's been a slight downward trend in the number of transactions, but obviously transactions like Santos have meant that the value of the deals that we are seeing, 2025 has outstripped 2024 by a country mile. And I think Australia offers a stable political regime. It offers good rule of law. And I think it is one of those places now that where you look at people wanting to put capital, Asia, the Asia-Pacific region, India, Japan, and Australia are key focuses for lots of investors at the moment.
Stay with me, Sandy. We'll be back in a minute. I'm speaking to Sandy Mack, Head of Corporate at Corrs Chambers Westgarth. Ahead of the break, we were talking about the benefits of investing in the Asia region, including Australia. We talked about the Santos deal. The reason that its share price is trading nowhere near what the offer price is because of regulatory uncertainty. That, in that instance, it needs Foreign Investment Review Board. Another one, James Hardie buying Azek. There was a lot of furore over that James Hardie's shareholders, local shareholders, didn't actually get to vote on that, notwithstanding it's going to have a primary listing in the US. Is this, are they just two unusual examples, or is there just more regulatory scrutiny going on at the moment?
I think they're two very different examples. And I should caution you by saying that we were involved in both.
Right.
And we are currently involved in the Santos transaction. So I have to be careful what I say. But I think fundamentally that it's no surprise to anyone that this is it's a large transaction with a foreign shareholder that's looking to buy it. And so FIRB will always be something that you have to navigate. I don't think that FIRB has become worse, if you, in inverted commas. I don't think the policy settings. In fact, I think it's gone the other way. In our experiences acting on a number of transactions recently, what we are seeing is a really willing executive trying to facilitate transactions within a good time frame. And I think hats off to the regulator for that. Every deal has to be looked on its merits, and national interest is the thing that will be driving a lot of the considerations of transactions. So that's on the FIRB front. Azek and James Hardie, completely different.
Yep.
And I believe that there are some murmurings about potentially changing our listing rules in order to accommodate a shareholder vote in these sorts of circumstances, where there's quite a significant percentage of the bidder's shares being issued as consideration. At the moment, you only need it if it's effectively a reverse takeover, which is a 50% issuance. So I think where we come back to is each situation is different. I don't think that the regulatory landscape has shifted so dramatically to make it worse. Having said all that, we have the merger clearance rules coming in January 1, 2026, which will be quite a different regime for everyone that's used to practicing M&A here. And so we are going to have to adapt to doing all of that as well. And that one remains a slight unknown in terms of how execution will play out.
So just give me a thumbnail sketch, not being quite across those, Sandy,
yes.
A thumbnail sketch of what that means.
So currently, our regime, our ACCC merger clearance regime basically says that if it's not going to be a substantial lessening of competition in merging two companies together, you don't need a formal ACCC clearance. We are moving from the 1st of January 26 to what we call a mandatory suspensory regime. So if you hit certain filing thresholds, you are going to have to make a filing and get clearance.
Yep.
That was one of the bases that I predicted that this year we would see much more activity as people try and get their deals ahead of that merger clearance regime. I still think that is the case, but I think we're now in the second half of the year, so everybody is starting to turn their minds to what happens if it doesn't get cleared this year. What do we need to be doing in order to ensure that we can get through the ACCC framework in sufficient time to close our deals next year?
Sandy, you must be close to a lot of these deals. Do they fail mostly on financial issues, or do they fail on personality issues, cultural issues?
Largely, it's financial, in my view. There are most of the clients that we work with are highly sophisticated deal makers, and there is a real understanding of how to deal with people, personalities, and cultural alignment. I think culture clashes make execution potentially marginally more difficult, but if the numbers are right and the valuation is right, people will get a deal done.
Cash always wins. So, looking forward, what about the next 12 months? What are we going to get, Sandy? More of the same sort of thing?
Well, what I will predict is that we have an M&A outlook coming out again this year. So I will have much better data.
Not till
October, November. Yeah, I'll have much better data at that point. But from where we sit right now, we're tracking towards a pretty good year. all of the political and geopolitical instability notwithstanding, we're tracking to have a great bumper year by value of deals. I think by number of deals, we'll probably end up better, if not, at least the same as we had last year. And I think the key will be execution. It will be, being really deft in your execution, being really quick at doing deals and finding creative solutions to bridge valuation gaps as always. Because I still think there is a little bit of a delta between buyers and sellers. It's not still fully a buyer's market. So people still need to get to this position where they're convincing vendors that the price is right for the transaction.
I mean, the Santos deal is an example where at some point in the last couple of years, and I'm not asking you to comment on this in any way, it and Woodside had spoken from media reports. It went on and on and on. It just didn't ever get done, right? Now, whether that's right or not, the point being that when deals take a long time, they don't seem to get across the line. So how much value is there in doing the deal quickly?
Yeah, I think the mantra time kills deals is definitely true. I think particularly in public M&A, in listed company world where there's share prices are moving all the time. You've got people trading, you've got arbitrageurs, you've got the hedge funds in and out of the stock all the time. I think getting it across the line as quickly as possible is probably one of the more important planks of your execution strategy in M&A.
Sandy, thank you for talking to Fear and Greed.
Thank you for having me.
That was Sandy Mack, Head of Corporate at Corrs Chambers Westgarth. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.